Hi everyone, in today's video I'm going to respond to a question that comes quite often from my clients who are entrepreneurs, which is, should I invest in my corporation? So basically we're starting off with this current profile. You are an entrepreneur, you have your operating company, you have started to accumulate money in your corporation, so you've accumulated profits, and you're at the situation where you could either invest those profits within the corporation, or perhaps you're considering investing that money personally. Could be for stocks investments, could be for real estate, but you are ready to size opportunities. So the first question to ask yourself when you're considering whether you should use your corporation or not is to think about how much money do you need for that investment and how much money would you have left after taking it out from your corporation. We have to keep in mind that when investing using your corporation, if it's an active company, it's active business income, the tax rate is pretty low compared to individuals. So it could be as low as 12 to 11% depending on which province you're in, but the tax rate is very low compared to how much we pay taxes as individuals. So at this point, when you are looking at your profits in your corporation, these have been taxed quite low, and this allowed you to keep much of it to be able to use it for your overall investment that you're not considering to do. If you are considering investing, if you were to take that money and pay yourself, you'll have to pay yourself dividends or a salary, and then you will have your personal tax rate that will be added to that. So you will have paid taxes once. Here could be as low as, let's say, 12%. But now that money, if you're paying yourself dividend, will have to be taxed as well, and that can go pretty high. That could go as up to 50% depending on your tax rate and how much money you've paid yourself throughout the year. So for these reasons, if you need a certain amount of money, you have to keep in mind, if I'm going to be using it from the corporation, I'm already using or making more out of the same amount. If I want that same amount, let's say I need 100K, if I need that same amount but I'm paying myself, there will be little to nothing left unless I pay myself way more in order to reach the net amount that I need. So this is the first consideration to keep in mind. If you are able to pay yourself but use some tax credits to lower your tax impact, that can be beneficial. I have some clients who also have access to their money personally. They have savings and they just need a portion of their profits to be able to combine it, or they have other sources of income. And when that's the case, you could consider the company to lend you money. So the company could lend you money, but there's limits to that. But this could be a way to quickly combine money that you had with money that you have in the corporation and make your down payment. Let's say if you're looking to purchase a property and you know for a fact that within a certain amount of time, you'll be able to refund your corporation. That's the way to do it. Now I will go with a scenario where the money, most of it or all of it, is within the corporation and you are inclined to invest within the corporation. Now, another thing to keep in mind when investing using your corporation is that you will not be benefiting from the same tax rate as your company. Your company is generating active business income, which is not taxed the same as rental or passive income. So if you're going to be investing directly with your operating company, it is not a hack to be able to pay the 12%, let's say, of tax rate that I was talking about. This is only eligible for a certain type of income, which is the active one. If you are generating passive income, whether it's through interest, it's through rental, or other investment that you've made in corporations, chances are that you will have to pay a tax rate that is even higher than your personal tax rate. The truth is that generating passive income using the corporation is not always the best bet when it comes down to tax optimization. If I have a client who's wondering whether they should purchase real estate using a corporation or under their name, the tax rate is not going to be the advantage to doing that. We're only considering it here because the money was within the corporation and it will cost a lot to take it out to invest. So we have to keep in mind that the tax rate can be as high as 50% when it comes to generating profits from passive income with the corporation. So that's a point to take into consideration, because you will want to compare paying yourself and be able to generate that income under your name and paying less versus doing it through the company. So that is something that I really wanted to address, because some people will think that because they are buying a cottage and they're gonna do Airbnb, they might as well do it in corporation to have the same tax rate as their business income. It is not the case. It will be completely different, and the only way or the only time when you're finally benefiting from a lower tax rate is when you pay yourself dividends. So yes, the tax rate is higher, as I just mentioned, but down the line, when you finally pay yourself dividends, you will somehow get some kind of a tax refund for the taxes that you paid that were much higher. But that's only when you finally pay yourself, which is not always the case. Sometimes the goal is to build a portfolio and not necessarily pay yourself before a while. Once you are completely aware of that and you're making a decision based on other reasons, you are going to have to consider what is your purpose of the investment that you're making. So are you investing your cash that's available within the company for short term? Let's say you have extra cash, but you know that you might need it 6 months from now, a year from now for your day-to-day. When it comes to that, you could consider investing it within your main corporation, because down the line, or at least in a short amount of time, you'll need it again. So the goal is not to go ahead and purchase a property. The goal is not to go ahead and do some investment that could be at risk. The goal is really to invest them safely, just so you have a return on investment in the meantime. But if you are investing for long term, so if you're planning for years from now for your retirement, then you should consider investing not in the operating company, but in a different structure, which we would call the holding company. So now we would have a different type of structure where you still are here, but instead of using your operating company, you would want to create what's called a holding company. So the holding company replaces you as a shareholder. You're still here, but you have this indirect entity that's now own the shares of your operating company. The benefits here is that when you transfer dividends, which are your profit that you had, when you transfer your profits from the operating company to the holding, there's no additional taxes. So you still have your only low tax rate we've talked about. And when you send it to the holding company, no additional taxes, so you get to use the exact same amount that you've transferred to be able to make your investments. So if you're planning long term, if you're planning to purchase real estate, if you're planning to invest in the stock market, but you know to build it for 10 years from now or for when you stop working through your active business, then for these I would recommend having a more sophisticated structure and using a holding company, just because you can make a complete distinction between your operating revenues, your day-to-day, your cash flow, and having your holding as really your savings account for long term, which you are reinvesting and generating new income out of this. As mentioned, the new income, yes, will be taxed as the higher rate, but at least we're really separating them, which is also completely reducing the risks when it comes to your day-to-day activities. If you're providing goods or services that are potentially at risk, let's say you're selling products, or you're the food industry, or you are offering services for which there could be a lawsuit, then you will want to go ahead and save your extra money and build your portfolio of assets distinguishedly from your operating company. You want to be sure that whatever you really want to hold on to is in the holding company. That's one of its main purposes, to really go ahead and own the shares in your operating company, but split them so that what you need for the long term remains here and your investments go over here. So that's it for today's video. I really wanted to go and explain overall what should be taken into consideration when investing, whether you should do it under your name or through your corporation if you are an active business owner and you already are incorporated. So these were the few factors to take into consideration, but in this video I just wanted to pinpoint the most important ones according to me. If you are looking for more advices on structuring your business, holding companies, tax tips, do not hesitate to reach out to me for a consultation. Thank you for watching this video and see you in the next one.